US and China trade talks continue this morning with more to do. US inflation data for May will show if tariffs are pushing up prices. Australian business conditions are their lowest since 2020. And traffic movements in New Zealand show diverging economic activity. That's coming up in our 5 Things in 5 Minutes on Wednesday, June the 11th. And then in the second part of a deep dive interview into OPEC's production cut phase-out, ANZ senior commodities strategist Daniel Hynes explains why he will be keeping a close eye on what the oil bloc decides in September.
If they do continue to raise output at these sort of elevated levels, then it's pretty clear that OPEC has really given up its ability to drive prices higher and effectively wants to put more volume in to ultimately see more dollars come through the door.
But first, in 5 and 5 with ANZ, I'm Alex Tarrenton for Bernard Hickey. Trade talks between the US and China continue in London, with the US Commerce Secretary saying the teams had more to do in an evening session, or morning Australia-New Zealand time. Meanwhile, US small business optimism rose slightly in May, according to the NFIB survey. ANZ head of G3 Economics, Brian Martin, says the survey's uncertainty index also rose, though.
The index still remains 4 points below levels in January, and that reflects that there is ongoing concern amongst businesses about the outlook and outcome for taxes, for trade negotiations and tariffs. It is encouraging that the survey did bounce off the April lows, and that does suggest that conditions and certainly business outlooks are not continuing to deteriorate at an accelerating pace.
At 4 a.m. Sydney-Melbourne time, the S&P 500 was up 0.31% as traders waited on those trade talks. The 10-year US Treasury yield was down 1.7 basis points at 4.466%. Gold was down 0.27% at $3,345 an ounce. West Texas Intermediate futures were down 0.08% at $65.24 a barrel. The US dollar index was up 0.06%. The Aussie was up 0.03% at 65.19 US cents, and the Kiwi was down 0.08% at 60.42 US cents. Number 2. Eyes are now on US May CPI inflation data. ANZ international economist Tom Kenny is expecting the important core measure to rise 0.3% in the month, up from April's 0.24%. That would give an annual core inflation rate of 2.9%. Headline CPI is expected at 0.2% in May and 2.5% annually.
We think May CPI data will show some of the increased cost pressures facing businesses being passed on to consumers, particularly via higher goods prices. Apparel and new car prices are 2 spending categories most vulnerable to tariff hikes. Secondly, on service prices, the 3-month moving average of core services is currently tracking at a bit above 0.2% month on month, which is in line with its longer run trend. This suggests that services inflation, which is the largest component of the CPI basket, may be close to normalising.
Number 3. Here's Tom on how officials at the US Fed are likely interpreting current data as they look at when they can ease rates again.
Fed officials want time to see how tariffs impact inflation data in coming months. As the May employment data show, the labour market is in reasonably good shape. This affords the Fed the time to be patient with its monetary stance. The central bank is currently wary that tariffs might cause a persistent rise in price pressures, given that inflation has been above target for several years now. We think that by September, the Fed will have enough evidence that tariffs aren't leading to a persistent increase in inflation. This should give them the latitude to cut rates then to stem slowing activity and employment growth.
Number 4. Australian business conditions eased in May to their lowest point since 2020, according to NAB's survey. Business confidence rose slightly, but remained below its long-run average. ANZ senior economist Adelaide Timbrell says some indicators did improve from April.
Forward orders, although still negative, have actually ticked up over the last couple of months. And although capacity utilisation is up sharply versus April, it is still down versus March. So look, a real mixed bag when it comes to those leading indicators, but with capacity utilisation and forward orders, as well as CapEx expectations back to where they were in March for the most part, we are seeing that, any big changes that occurred in April do mostly seem to have reversed.
Number 5. ANZ's New Zealand Truckometer Index for May showed light traffic activity, an indicator of current demand, up 0.3% from a year ago. Heavy traffic, which gives a steer on production GDP, was up 1.7%. ANZ New Zealand Chief Economist Sharon Zollner says the results fit with wider indicators of what's driving economic activity.
The fact that heavy traffic is growing more strongly than the light traffic is consistent with the fact that the goods producing parts of the economy, particularly agriculture, are performing very well at the moment. We've had good weather, we've got excellent export prices, we've seen our export volumes lift, whereas the consumers are still pretty subdued. The card spending we've seen, the housing market's still fairly flat, and things are picking up there too, but more slowly.
Sharon Zollner there. Now in part 2 of a deep dive interview into OPEC's move to phase out production cuts, ANZ senior commodity strategist Daniel Hynes explains why September is critical for several key players. You called your report on OPEC a fork in the road. So what could happen here over the second half of the year?
The ability of OPEC to put more barrels of oil into the market at the moment is certainly a reason why we've seen the increases. But certainly come September, when seasonal demand starts to fall, the ability of market to withstand this elevated or accelerated level of increases from OPEC will become significantly more different. And I suppose we'll get a real sort of view or idea on whether this shift in strategy is more opportunistic or more longer term driven. If they do continue to raise output at these sort of elevated levels, then it's pretty clear that OPEC has really given up its ability to drive prices higher and effectively wants to put more volume in to ultimately see more dollars come through the door for a lot of these Middle Eastern producers. On the flip side, though, if it is taking that opportunistic view, then it would likely pull back pretty quickly and revert to those lower levels of increases, potentially even pause if the economic backdrop weakens or there are other signs that the demand is not coming in as strongly as they expected. But certainly I think we'll have a much better idea over the next couple of monthly OPEC meetings of whether this is a permanent shift in their strategy.
And I guess that makes price forecasting hard?
There are, I suppose, two clear sort of scenarios to play out here over the next 6 months. Everything seems to be pointing towards OPEC continuing to increase output. And so I think that's only going to weaken prices. That's considering all other things stay equal. And obviously, there's a lot of moving parts, most particularly the global economy and the outlook, considering, where tariffs impacting economic activity and trade flows and the like. And so that expiration of the 90-day pause, pretty key to, I think, whether we see a further escalation of this trade war, which obviously could impact economic growth and thus demand, or we see a little bit of a stabilisation, I suppose, in that. But outside of that, I think there certainly are signs that this price weakness that we've seen is something which is going to persist for a little while longer.
Daniel Hynes there. I'm Alex Tarrenton for Bernatiki. That was 5 and 5 with ANZ for Wednesday, June the 11th. Catch you tomorrow with what that US inflation data could mean for FOMC rate cuts this year.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.